All right. Well, good morning and welcome to today's Monday morning mortgage update. My name is Sean Woolen with the Woolen Mortgage team here at Waterstone Mortgage. And I'm going to be going over what the heck is happening with rates. Everyone wanted or expected rates to be in the fives by now. Why aren't they? Can we expect that? What will have to happen for that to happen? And what is the near and future trends show? What are they showing for us? So I'm going to go ahead and share my screen once more. Bear with me one moment as I jump in here, and we're going to take a deep dive into what's happening in the mortgage industry, what we can expect, where we're at today, and we're going to explore the mind and the mentality of sellers versus buyers and what we're up against because it's definitely a very unique market. So let's dissect this and jump right in and see where we're at. So first off, I want to show you the mortgage-backed securities over this past year. We've had a roller coaster run. It has not been normal. So if you look back all the way to last July, which is all the way here on the left, you'll see that the Fibonacci or the Fibonacci hit level at the 100.96 held strong, but mortgage bonds were way down here on the left, and then they got significantly better, and we had a really good run for half the year up until January. And then we went all the way, we hit 5.99 and we started to go above that. And then we saw some pretty quick adjustments to that. So as you notice, these small blips higher, they don't last. So when people are saying they want to wait for mortgage rates to hit a certain amount, they only hit that for a few days, maybe a week or so. But we had a quick drop here, and then we came back up, and we were hovering right around the 6.125 for a while here. And then this is when the war started in Iran, and it was just a complete cluster for about a full month. Um, and then we saw a potential ceasefire, and we had some good talks, and things got a lot better. Oil prices came back down, and then more fighting, and then potential peace talks, and then more fighting, and then just being crazy. And then this last month, it's just been more fighting. So today we do have potential peace talks. So let's see what's happening in the short term on the mortgage-backed securities. But look at this volatility, guys. Um, it's been crazy. And when customers get pre-qualified when rates are good, and then 2 weeks later rates are bad, it's frustrating to them. But let's go see kind of where we're at right now. So since June, you can see June's right in the middle here. We had a peak right around June 29th where rates were at the best for the last several months, and then the war started again. We had a couple of good days where we thought maybe there was some hope, and then we lost a lot. Last week we thought I saw a little bit of hope, and then we lost a lot. So it's just been rough. Rates are at their worst point right now than the worst point in the last 12 months. So it's not great, but it is what it is, and there's not much we can do about it on our sides other than just educate our borrowers so they understand, educate our sellers so they understand, and that takes us into. I'm going to go over the 10-year real fast. This is the 10-year, and it hit. If you can see this back in mid-May, it hit a high point of 4.67, and some people thought it was going to go all the way up to 5. But as you see this last couple weeks, 10 years risen. And when the 10-year rises, 30-year fixed mortgage rates rise as well. So we went above this Fibonacci level today, which I don't like. See this line? When we pierce through that, it means most likely we can go all the way to the next level. So I'm not really liking that. But here's where we are on actual interest rates. Keep in mind, this is the perfect borrower. This is 25% down, single family residence, primary residence, 780 credit score or better, this is the rates you can expect. So 30-year fixed, we're close to 7. 15-year, you're in the low sixes, low to mid sixes. 30-year jumbo, you're close to 7 as well. Adjustable rate mortgages, you're in the low sixes still. 30-year FHA, low sixes and mid sixes on the FHA and VA. So we are higher than we were. Last week, we were in the 6.6 range on the 30-year fixed. Now, or 6.7 range, now we're at 6.8. So we are squeezing a little bit higher on that. So what's going on? I mean, why are rates doing this? Why are they vacillating back and forth? Here's a really good breakdown of what's happening and right now, and then what we need for rates to come back down. So first off, I don't know if you heard, but the Japanese yen is in trouble. It's at the yen is at their lowest point since 1986. That's the lowest point in 40 years. So the U.S. intervened and they bought a lot of yen to help stabilize their markets. This is bad because it creates debt on our side, which is not good for long-term bonds. So that hurts mortgage rates. We still have the Strait of Hormuz, and it's still having war issues, which higher gases, higher inflation, higher rates. So that's still an issue. This Iran thing has just been a debacle for mortgage rates. In the Fed level, we have three of the Fed presidents that are saying that they wanted to hike rates. That's right, they wanted to hike rates. They think inflation is still out of control. So they think that raising the rates will have a bigger impact on helping inflation. So three of the Fed members wanted to hike rates, which was crazy. That would put an incredible amount of stress. Basically, what they want to do is push us into a recession, and that will bring down inflation. Jobs have also been relatively strong. That's one of the reasons rates are high. If the economy is good, there's no reason to make things cheaper. There's no reason to lower rates. So when the Fed looks at the jobs being strong, and by the way, the data on the jobs are terrible, so they're always wrong. But when the Fed sees jobs are strong and they see inflation is high, they're wanting to potentially raise rates because jobs are strong. And that's their two things they focus on is inflation and jobs. Now, what can keep rates lower? We really want this war in Iran to end. Ending that will bring gas prices down, which brings inflation down, which will help everything. The jobs report, this is jobs week. We're going to see a lot of jobs data. We need weaker jobs. We need weaker jobs because that's going to show a weaker economy, which will mean lower rates. We definitely need lower inflation. And I don't know if you've been watching, but these data centers that they're building, the amount of materials that are needed for these is causing inflation because the suppliers of these materials like gravel, concrete, things like that, precious metals, they can demand a higher price, which is inflationary. So that's actually been interesting to watch. These data centers are causing a little bit of inflation on those pieces. So watching that really carefully. But inflation needs to come down. That is for sure. That is absolutely for sure. So what's happening this week? Today we had construction spending, ISM manufacturing numbers, kind of bleak, which is a good thing. We have factory orders coming in tomorrow, JOLTS, which is job opening and labor, basically new job openings that are being posted. This number is usually way off, and here's why. In today's market, if you're a company that's advertising for job openings, because of the remote jobs, we can now advertise jobs in multiple states for the same job, and those job openings are being counted multiple times. So you may see this jobs numbers the JOLTS number be really high because one job is being advertised multiple times across multiple states, and they haven't figured out how to really account for that. So those numbers aren't really correct. Jobs numbers, guys, that whole world needs to be revamped. All right, so Wednesday we have ADP payroll change. We have ISM non-manufacturing, and then Thursday we have Challenger job cuts. We've got initial jobless claims. We've got the unit labor cost, non-farm payroll productivity, and then Friday is the big unemployment rate. We have non-farm payrolls, hourly earnings, average weekly hours. The average weekly hours has come down a little bit, but it's interesting to see how the unemployment rate seems to stay steady despite all of the challenges in the market. So that's what's happening this week. Right now, guys, buyers and sellers are on two different planets. And when I say that, I literally mean they're on two different planets and we are caught in the middle. On the left side, we have buyers on this blue planet over here. They feel like prices are high and they want a discount. Or they want it to be perfect. I mean, they're paying a premium, they think, for this house. So they want the house to be perfect. They feel rates are too high. So they want concessions and rate buy downs. So they're wanting everything. And they expect sellers to fix everything on a Binzer because they honestly believe they're paying a premium for these homes because they remember 5 years ago, rates or the homes were half price. So they're demanding this. They honestly believe it's a buyer's market, and so their demands are pretty high. They're pretty crazy compared to what's happening on sellers' side. So sellers, on the other hand, they're stubborn on their price. They like my home was worth 1.5 million 2 years ago. I'm not selling it for anything under like 1.45. I mean, I want 1.5, but I'm not going down to 1.3. I'm not going to accept that offer. That's terrible. I'm not even going to answer that offer, right? Um, and keep in mind, sellers, the mortgages they have on their homes, they're probably in the two or threes. So their holding costs are really low. They don't need to sell right away. So if they see a low offer of $50,000 below, they're like, no way, I can hold this and it'll only cost me $24,000 this year to hold it for a full year because that's how much my mortgage is. It's cheap. And some of them still believe their home is worth what it was at the peak, which we all know in the real estate market isn't really true. We have seen a little bit of a slide, not a lot, but we have seen more the price of homes come down a little bit. And guys, the sellers are not willing to put a lot of money into their homes, it seems. There's a lot of deferred maintenance out there. There's a lot of gross homes. Keep in mind, we can fix that with our rehab loans, roll the cost of all of the repairs into the loan, still put a low down payment, but there is a lot of deferred maintenance. And they're still holding out. They can take their time. They've got a low rate on their mortgage, low carrying costs. They can hold out for the highest offer because they still think they can get a high price. And they don't have to sell. I mean, to be honest, some people want a bigger house, but the rate's so low, they don't really have to sell. So we've got two different planets out there, guys. Buyers are on one, sellers on one, and we're in the middle trying to bridge the gap. And the only way we can do that is to help educate our sellers and our buyers. We can do things like the rate buy downs. There's a lot of options we can do, but I have never spent so much time with buyers up front going over and crunching numbers on multiple properties that they're looking at, multiple rate strategies. It's wild. And they're not happy with them. Even with crazy rate buy downs, they're like, it's still too high. So two different planets, guys. We need to bridge the gap. The psychology of the seller it's real. You can take, I mean, you can have, this is going to be available for you guys to watch on my YouTube channel as well. So you can do screenshots and send them to your sellers and buyers. But two different psychological worlds right now, and it's hard. It's hard to manage. And but things are still happening. But I've never seen so many buyers make offers and so many sellers get those offers. And I've never seen so many opportunities starting where no contract is actually secured, where they're just stalemate and nothing ends up happening. They don't end up going under contract. It's just a back and forth, and that turns into nothing. It's really, really wild. So we need to really have some come to Jesus moments with our buyers and sellers, because it is tough to get them to see eye to eye. Now, we're going to switch gears a little bit. We're going to go into jumbo loans. So I want to go over this with you because jumbo loans are a completely different animal. Jumbo loans, and I'm going to go over this in detail, are very, 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 very complex. And I say that in multiple ways. It's still the same process, but within that process are a lot of different things I'm going to go over with you. First off, we have over 250 different jumbo lenders that we go to every day to shop for different loan programs, different rates. And guess what? Every single one of them has different rates. Every single one of them has different guidelines. Every single one of them has different credit score requirements. Every single one of them has different down payment requirements, different loan to value ratios, different debt to income ratios, different turn times, and different levels of strictness. But guess what? Every jumbo lender or jumbo buyer wants. They want the lender that's going to give the cheapest rate, the lowest rate, and the least amount down. I promise you that's what every single one of them, that when they come to me, that's what they want. So 95% of these options get pushed aside. And guess what happens? We end up going into the loan programs, and we end up isolating them to the lenders that are the most strict, that require the most documentation, the most scrutiny, because those are the lenders that have AAA paper that are able to offer the lowest rates possible. So you kind of pigeonhole our borrowers into a very short list of lenders that have the lowest rates out there. And it ends up being really hard on the borrowers because of the requirements of a jumbo loan. So I highly, highly, highly recommend that we have a fully approved borrower before you go under contract on a purchase that requires a jumbo loan. So here's 10 tips that I put together. First off, platinum approval. This is a fully approved loan through underwriting. It identifies issues early. When we get documents from a customer on a self-employed borrower that owns multiple properties, that owns multiple tax returns, multiple companies, multiple K1s, you name it, they are typically shopping and they don't want to give us all the documents because it takes a long time to gather. So we get the one set of personal tax returns and they say, yeah, I've got my business returns, but it's so much, I don't have time to get them to you. Can you just work up what I have for now? And it doesn't work. We need all of the corporate returns. We need all of the K1s. We need to see if there's losses. There's a lot of behind the scenes things we need to look at. So doing it all up front is very important. They really need to pick their horse and get on the horse before they make an offer. And when I say get on the horse, choose a lender way before they make an offer. It's imperative. It's very important in the jumbo world. So platinum approval is fully approved up front. Don't go under contract unless you fully have a fully approved loan. It's dangerous. It's setting people up for failure. And I know every jumbo buyer, every person that buys a multi-million dollar home, they're like, I have lots of money, I have lots of income, I'm fine, I'm golden. But what they put on paper is not always what the reality is behind how much money they have coming in, and it makes it very, very complicated. So I would never go into contract unless you have a fully approved loan. I honestly would do the best you can. And I know you're competing with some cash offers in this realm, but try to get a 45-day closing. It's very important because sometimes these borrowers are like onions. They give you a set of tax returns, and then you see on those tax returns that there's 3 or 4 partnerships. Then you get the partnerships returns, and then you see that they sold a company, or there is K1 losses, or there's loans due and payable in less than 12 months that we have to dig into, and then you pull up those. And then they took a loan against their company, and now you have to go back to that company. I mean, it's just an onion. So we need time to go through it all if we haven't reviewed it all up front. The underwriting is very picky because these loans are not sold. The lender that we're doing these with and locking these loans with will keep that loan forever. It'll tie up their capital. So they want to make sure these loans are perfect. So they will ask for a lot more. So there's a lot more quality control. There's a larger risk for that lender because they do not sell these loans. So guess what? They're going to want more. They're going to want more detail. And every borrower will say, well, why do you need that? And the reason is because this lender is the actual holder of this note and they're demanding it. It's just that's how it works. So expect a lot more documentation. And when I say a lot more, it's everything. We don't just take your word for it. We're going to do a full-on physical, like all the way down to the colonoscopy. We need to see everything. It's pretty wild, but that's just how these are. So we need to make sure we're prepping our buyers and preparing them for multiple documentation. Now, a lot of these lenders have multiple underwriters. We underwrite it, then it goes in for second review, and then there may be an investor credit review. Especially on the super jumbo, anything over 3 to 4 million on loans, they are multiple sets of eyes. And guess what? We could have a full approval and then it goes to one of these other underwriters or second review, and we could have additional conditions. It's just the way jumbo loans are. And if you're trying to get the best rate, you're going to find the lenders that have multiple eyes on these to get it perfect so that they have AAA paper. So keep that in mind. So be prepared also for 2 appraisals. Depending on your loan amount, some appraisers or some lenders require only 1 appraisal up to 2 million. Some of these investors, if you're over 1 million, will require 2 full appraisals. We go with whatever the lower of the 2 is. We don't average them. So be prepared for multiple appraisals and also appraisal reviews. We could see conditions on appraisal that you're not used to. It's just keep in mind this money's being tied up by these lenders who own the loan. They want to make sure that the collateral is there. they're going to scrutinize appraisals. There is a lot of frustration, especially when borrowers have multiple companies. And sometimes these companies have companies within companies. There's shell companies. You may own an S corp that owns 12 other companies, which guess what? We need those companies' tax returns. I mean, there's all kinds of stuff, and borrowers do get frustrated. It's a lot easier on the borrower to do this ahead of time instead of while they're under contract. It's really, really hard to do it when you're under contract. So make them pick a horse, make them pick a lender ahead of time, dial it all in, get it done to perfection. Then we'll know exactly what we're dealing with, and then we can pick the lender that we has the best rate, or we'll know that we have to go to a lender that's a little bit more lenient, and we can give proper quotes that way. So yes, the best loan programs are usually the more strict of all. Here's a little drill sergeant yelling at you, get your stuff together. If you want the best rate, you're going to need to get us a lot more documentation. Get over it. That's how it is. It's kind of a funny little video or picture, but it's kind of how it is. Like if you want the best rate out there on a jumbo loan with the least amount down, you're going to have to follow the rules. You're going to have to follow the drill sergeant's rules because that's just how it is. And also during the process, because it's scrutinized so heavily, every little thing that changes is scrutinized more than everything else. So large deposits. I mean, it's unbelievable how detailed we have to get with these. So moving money around. A lot of these very savvy borrowers move money around a lot. It's hard to gather all the documentation for that. Financing furniture. I mean, Robin Stuckey back in the day, right? $150,000 for the furniture that's financed. Like that can impact your credit score. It can impact your debt to income ratio. All that stuff is highly, highly scrutinized because the levels of the payments on these are much higher and the level of risk is higher for the lender. So get buyers engaged way ahead of time. I do this a lot with my jumbo lenders. We get the financial planner involved, the CPA, the estate attorneys to make sure we're taking title properly, make sure the trusts are set up properly, make sure they're getting reviewed by the lender so we can put it into the trusts. We need to all be engaged ahead of time. We can't do it last minute, especially with CPAs, especially when it's tax season, because they just don't have the time to do what they need to do. So getting everyone engaged together early on is extremely, extremely important. So that's the jumbo world, guys. It is a different world altogether. And it's important that we engage our borrowers and let them know exactly what they're up against because it is very, very different than a conventional loan. The more simple you are as a borrower, the easier it is. A lot of buyers that have a lot of money think, I have a lot of money, I have a lot of income, it should be easier for me. The exact opposite is true. It is harder for you to get a loan because you have more pieces of the puzzle, kind of like a Lego set. If you're doing a 5,000 piece Lego set, it's going to take you a lot longer than doing a 10-piece Lego set. 10-piece Lego sets are simple. We can get them closed quickly. But if you have a lot of moving parts, it's going to take time and it's going to take a lot more scrutiny. So that's the jumbo world. That's the mortgage rates as we have it. And it's summer, it's hot. A lot of people are gone, but I am here. I will be here. I have no trips planned until my birthday in October. So if you need me, I am here to help, and I'm here to help navigate these crazy waters. And if you have any questions, I'll open that up and let everyone. I'm going to allow everyone to jump in and talk. So if you have some questions, feel free to jump in and ask away.